Welcome, welcome, welcome. I am your host, Ebony Beco, a mortgage loan officer and a mortgage strategist. I have been in this industry for over 25 years. So if this is your first time listening, not only I want to welcome you, I'll give you a brief overview so you'll understand why subscribing to this podcast and listening to me and just continuing to follow will assist you and help you make better mortgage decisions, buying decisions, and even to the point where you're able to share information to help others. I've been in this business for over 25 plus years, started in this industry when I was 16 years old. I started out as a loan processor, underwriter, to the point I became a realtor and an investor. And then I started really hitting heavy when it came to my mortgages because I love helping people. I love doing everything when it comes to real estate and mortgages. And my full focus is helping you understand everything when it comes to making the best mortgage decision and being very strategic about what you're investing in. So with that being said, this episode today is a 3-part episode, but this is part 1 of first-time home buyers. This episode is dedicated to the most common first-time home buyers questions that I get all the time. So in this episode, I'm not only going to answer these common questions, but I'm going to explain it and go into detail as to why these questions are being asked and why my answers are what they are. So that way, you will not be confused in the future. Any questions that you thought you may have had, you're going to find them on this episode. And if not, there are 2 more to go. So let's actually get started. First time home buyers, common questions that I hear every day. How much of a house can I afford? Well, here's the thing. This is usually the first question that a lot of buyers ask. As a matter of fact, you need to know that before you even go see a realtor. And not only just before you go see a realtor, but you need that pre-approval in hand. So your affordability is based on your income, your monthly debts, your credit profile, and the down payment. But interest rates does play a part in it. Now, qualifying for a certain amount doesn't mean that you should spend that amount under no circumstances. I remember when I bought my first property at the age of 18 years old. I don't know if it was 18 or 19, may have been 19. And I was a loan underwriter, and I was making I was 19. I was 19 years old, and I was making around $120,000 as a kid, right? And I was doing underwriting. Well, I had a realtor, and he is still to this day with Coldwell Bankers. I'm always, shout out his name, Bob Showalter. And I think I qualified for like a house for $250,000 at a young age. And Bob was like, no, as a father, it's hard for me to allow you to spend that as a father. And you are a single mother with 2 boys. I cannot allow that. Like my conscience and ethics would not allow me to do that to you. And so with that being said, Bob proceeded to show me other properties that was not in the range that I was looking for. But because he had an idea what I was looking for based upon the properties I was sending him and the areas I was showing him, he's like, you know what, Ebony, let's try this particular area right here. And we went to that area, and the homes that was over there looked practically identical to the same townhouses I was looking at. But you know what? I ended up putting one under contract for $64,000 versus $150 versus the $250 that I qualified for, because that was something that he said as a father first. I cannot allow that. I would not feel right. And understand, in this industry, whether you're in real estate, whether you're in mortgages, the more money that the borrower and the buyer spend, the higher the loan amount is, the higher the purchase price is. Guess what? We actually make more money. But it wasn't about the money. It was about his values and his ethics and just what made him feel good. Right is right, wrong is wrong. And honestly, this is one of the reasons I do this podcast. It's not about getting information it's not about trying to get business. It's really legitimately about sharing knowledge, sharing business, because I have been blessed. And I was blessed with that realtor who helped me get my first home at the age of 19 years old. So with that being said, how much you can afford is based upon your credit, based upon your debt and all of that. But it does not mean that's how much you should actually spend. Now, the reason I say that is because the reality is you need to spend what you feel comfortable with. Just because you can afford a $250,000 house does not mean that that's what you should do. Especially, remember, I had 2 young boys at the time. So, and by the way, I forgot. 3 years later, I sold that townhouse and I sold it for $140,000 without a realtor. And I did that by myself, not knowing the real estate industry at the time because I was strictly in mortgages. And that was one of the things that opened me up into when you buy, you should be really smart and careful with what you are buying. How long are you going to be there? What do you think your intent is? So it's so much that goes into your first time home buyer ownership, but you definitely want to make sure you have all of your I's dotted and your T's crossed. My role here is to help you just basically choose a payment that fits your lifestyle, not just the maximum a lender may approve, but what's comfortable to you. And just realize it's okay to start with something smaller, even though you're approved for much higher when you first start out. I don't care if you start out at 19 years old or you start out at 70 years old. It doesn't matter what is comfortable to you and what's going to make sense. My next question that I get is, how much do I need for a down payment? Now, one of the biggest myths in real estate is that you need 20% down. Many first-time home buyers actually only put as little as 3% down to 3.5% down, and some actually qualify for 0 down programs. Now, the amount that you need is going to be dependent upon the loan programs and your situation. A large down payment is not always required for home ownership. There are down payment grants. And if you're working with a good realtor who knows how to negotiate, let's go back to that $250,000 house. Maybe the realtor can actually talk to the seller and say, hey, real quickly, here's the contract right here. $250,000, you contribute 3% towards the closing costs. Well, here's the thing. If you're approved for 97% and they contributing 3% towards the closing costs, 97 plus 3 is 100% LTV, which means you're responsible for just the closing costs. The 97% is the loan that you would be approved for based upon the purchase price. The 3% is what you have to come up with. If the seller is willing to contribute 3% towards the closing costs, that is that missing 3% gap plus the additional closing costs that you're missing. Now, if you get approved for down payment assistance, guess what? You are actually not paying anything at closing. As a matter of fact, you might have a credit at closing. So these are things to be very conscientious of, that it's a possibility you can buy a property with 0 to 3% or little to no money down. It depends on how your loan gets structured and just you having the knowledge to understand what's out there and what you can get. Now, what are closing costs and how much are they? That's another question. Remember, I just mentioned closing costs. So closing costs are the fees required to finalize your loan and purchase the home. These can include everything from the lender fees, because every lender is going to have a fee. So please don't let nobody say, oh, they're charging too much. Remember, when you went and bought that car and that car was $80,000, well, by the time you was done with the title fees and estate fees and the transfers and all of that, that went from $85,000 to $92,000. This is no different. You will have to pay, like I said, the lender fees, the appraisal, the title charges, whatever the title charges are, that is out everyone's control, the escrow, and any prepaid taxes and insurance. Now, this usually runs between 2 and 5%. And like I said, that's why that down payment assistance program can actually be of assistance to you. Now, and when I say 2 to 5%, 2 to 5% of the purchase price. So again, if we're talking about $250,000, that's 2 to 5% of that, which would potentially be the closing costs. And this is really important for you to understand that before just going in purchasing a property. Now, can I buy a property with little money down? Absolutely. Absolutely. Depending on the loan program, you absolutely can. Whether it's a VA loan, a veteran administration loan, because maybe you served in the military. Yes, USDA loans, they also offer like zero down options. And then, like I said, those down payment assistance programs that can significantly reduce the upfront costs, or even sometimes actually just reduce the costs as a whole. And then, of course, you want to make sure that the realtor that you're working with knows and not afraid to do any type of contract negotiation. Just know that if it's a good property, that it might be a lot of competition out there. So you could be going against that. Usually the properties that work really well with, if you see where it says you have a seller that is, very encouraged, like looking for, they're saying they're willing to pay closing costs. If you have a seller or a realtor that's saying, okay, this property, the seller is anxious and ready to close, those are the ones. Or you got a property that's been sitting there on the market for like over 4 months, it's easier to negotiate those. And if you find out that they don't have a huge mortgage on there, because sometimes it's kind of public information, they haven't taken out any recent mortgages, and if their house is $250,000, their mortgage is $90,000, it is so much easier to negotiate. But I'm not saying take their money, because if that house is worth well over $250,000, please don't try to cheat them. But it's okay to ask them to contribute towards your closing costs. Now, many buyers as a whole qualify for so many different programs without even realizing it. This is why it's so important to ask the right questions at an early stage of the process. Now, are there first-time buyer grants and assistance? Absolutely. When you're working with the right mortgage broker and the loan officer, they can pretty much tell you what's out there, because to be honest with you, you shouldn't have to research these programs. Like, that's the reason why they're your mortgage loan officer. If they want to be serious about helping, then they can help you find these programs, because that is what's going to make them a really good loan officer, a mortgage consultant. And I say that because when I think of the word consultant, I think of somebody that's willing to go above and beyond. Whatever that actual title is, whether it's a real estate consultant, but they're a realtor, but they're making sure, okay, your credit is in order. No, I'm not getting paid for this, but I'm leading you in the right direction to help you grow. That is the thing. Now, when it comes to these different programs that are out there, they can actually help like with the down payments. They can help with the closing costs. They can help with actually both. Some of the grants are forgivable, and then some of them are not, right? Some of the grants come with low interest rates or second loans. Now, the eligibility often depends upon the income, the location, and really the buyer's status. Like, okay, are they a first-time home buyer? Things of that nature. What is their income? Meaning if they are like above like an average medium income range, AMI, if you see something like that, then that might be something different, meaning they make well over $125,000 or $150,000 a year for a certain type of property. Then there's certain grants they're just not going to qualify for, but if they below that, then they will qualify for some of those grants, because the whole purpose is for just pride of ownership, allowing everyone to become the homeowners. Now, another common question: what will my monthly payments be? Upfront, no one knows. Your mortgage payment includes principal, interest, property taxes, insurance, and sometimes HOA fees if you are purchasing a property that is maybe a townhome that has an association, a condo that has an association, and then you have some regular homes, single family homes that's in the gated communities that have associations. So that is included when it comes to what your monthly payment is. There are online calculators, like even on my website at homeloansnetwork.com, that can help you estimate this. But there are some online, just kind of Google, mortgage calculators, payment estimates, and you're going to find a lot of different calculators. This will help you personalize numbers and just kind of give you like a real sense of clarity to help you understand and be able to plan accordingly on how to prep yourself up to become this first-time home buyer and not drain yourself. Do I need money saved after closing? Well, some loan programs do require reserves. Many of them will turn around and say, okay, you may have money in the bank after closing while others don't. Like some really don't care. What I mean by some don't care if you have money in the bank after closing. Then there are some that say, oh, you have to have reserves, like meaning even after closing, we still need to see you have 6 months of mortgage payment in the bank or a year mortgage payment in the bank. Even when the reserves are required, having savings provides financial stability and a peace of mind, not just for the homeowner, but definitely for the lending institution who's giving you this money or who's loaning you this money. Another common question: what credit score do I need to buy a home? Now, there's no single credit score requirement. Some programs allow scores in the 500s and others require higher scores. What matters most is your overall credit, not just the number, but it's not even just your credit. It is also your income, because you can have an 800 credit score to attempt to buy a home, but if you don't have the income and you're not filing taxes, it really don't even matter. So you still can't get one. And even if you go stated, and that's a whole nother podcast, everything needs to be lined up. I will say that, because even if you go stated, now you're not going to get approved for that 97% and 95%. The loan of value, what they're going to approve you for, is going to be much lower, which means you have to come to close with more money. With that being said, that goes back to what I previously said about the reserves. You will have to have enough money in the bank to be able to close on the loan. So yes, you want to try to make your credit score as good as possible and make sure that you have the income. But like I said, there are programs that are out there and work around certain things. So don't ever think that home ownership will never be possible for you. Can I buy a house with average or bruised credit? You absolutely can. Many home buyers don't actually have perfect credit, and perfect credit is not even really a requirement. Lenders look at patterns, recent history, and how they've been managing their credit like in the past and even over time. Even if your credit needs improvement, there are still potentially so many solutions for you outside of just fixing your credit or trying to get your credit score increased. There are so many different programs that you can do. Do student loans hurt my chances? Not necessarily. Student loans are factored into your debt to income ratio, but different loan programs calculate them differently. Having a student loan does not automatically prevent you from qualifying for a mortgage. So that is a myth, okay? Do collections or late payments matter? It depends. Now, medical is not a big thing anymore. It used to be back in the day. I'm not telling my age, but it used to be back in the day. Right now, it's not even a big thing. As a matter of fact, the government actually passed a law that they cannot, the medical can't even really be counted. And I'm not saying go get some medical debt. That is absolutely not what I'm saying. What I'm saying is you do want to make sure that you don't have no collections if possible. Just each loan program treats collections differently, which is why the strategy matters even more, and to understand your credit first. Even if you do just a soft pull in your credit report, or you go to freecreditreport.com, your annual report, your free annual report. Even if you do that, just see what's on there and just start cleaning the simple little things on there. I'm not saying pay off everything. I mean, that's great, but sometimes you have to start from something to get somewhere. So you have to start from A to get to Z. You have to start from goal to get to the finish line. So if you don't do anything else before you even talk to a loan officer, just get your free annual report. And that's free once a year. Do I need perfect credit to buy a home? Nope. Stability, consistency, and recovery is what matters, far more than perfection. Home ownership is achievable, even if your credit profile isn't so flawless. You still can potentially own a home. How long do I need to be on my job? Most programs look for 2-year employment history, and they really do not want a gap. So make sure if you do have a gap, there's an explanation as to why there was a gap. Maybe you're in school. Now, when it comes to the employment, like I said, not necessarily you don't have to have, you can have another job, but that's, when it comes to the, how do I say this? When it comes to the job stability, right? They want you to have 2 years of employment, but say for an example, there is a slight gap, just slight. You want to have a letter of explanation, but they do prefer you to have been in the same line of work. So for an example, if you was a nurse and you was a nursing assistant, you go over to be a dental assistant. It's still the same thing, Now, if you was a nursing assistant and all of a sudden you go to be strictly just an Uber driver, no more, no less, then that could be questionable, especially if you're in a situation where already your credit score is low, because again, a lot of banks will potentially approve you with a lower credit score with compensating factors, meaning job stability, income consistency. And that's why I said consistency and stability is what actually matters, not having the perfect credit all the time. Now, when it comes to how long you need to be at your job, you want to have been there for at least 2 years. If not, at least have a 2-year history. So even if you was at that job for 6 months, but you left that job and then immediately, like I said, went to go be a dental assistant from being a nursing assistant, you're fine. Just have the 2-year stability. Job changes, promotions, and self-employment can qualify when properly documented. So don't think that you have to keep working for the corporate company just to purchase a house. No, just make sure it's documented. Just make sure you file the taxes where it can be verified. And because the lenders will verify your income by having you to sign an 8821 and a 4406, which is an IRS document to verify your income. So no fraudulent tax returns, no saying this is what you make and you don't, unless you're a real estate investor who's doing like a stated and no verification type loan. That's a difference, but understand that if you was going that route, you would need at minimum 20% down plus the closing costs. So for first-time home buyers, it is absolutely important that your income is verifiable and your assets is verifiable. Now, what's the difference between an FHA, conventional, VA, and USDA loan? Well, each loan program serves a different buyer profile. There's the FHA, which has more like flexible when it comes to credit. Then there's the conventional loans that reward stronger credit, right? FHA is usually going to have a PMI, which that means that's additional money that you're going to pay on top of the mortgage and any escrows. Conventional is a different story. Okay, so conventional loans, they're rewarded based on the stronger credit. VA loans are eligible for veterans and service members. And VA loans, you can get those at 100% financing, unlike the conventional loans in the FHA. Same thing, USDA loans. They're based on the location, though, and offer zero down options. So when I say USDA loans, these are loans that are like more in the rural type area, the farming area, areas whereas you don't have really no neighbors out there. But the reason they offer those loans at 100% is because of the fact that you don't have people going out getting USDA loans every single day like they are doing FHA and VA loans and conventional loans. So that's a whole different type of loan, whole different type of world, but it is backed by the government just like the FHA and the VA loans. Now, understanding these different loan types will actually help you when it comes, for you as a first-time home buyer to not only just purchase your property, but let's say, you're the Gen Zs, like I have a Gen Z. Gen Zs are trying to purchase properties right now. Even as a parent, it is important for my Gen Z to understand the importance of home ownership, even if he decides he don't want to physically own the home that he's living in, but he wants to buy a home for the purpose of using it as a real estate investment property. Still, him knowing what's out there is extremely important. Now, which loan is best for a first-time home buyer? That's another common question. There's no one-size-fits-all to this answer. The best loan depends on your credit, your income, the down payment, location, long-term goals, meaning what it is that you intend on doing, how long you intend on being there. Do you plan on getting married? Do you plan on having children? Because that's going to play a big part in it. Personalized guidance makes the big difference when it comes to finding out what is the best type of home solution for you. So before I wrap up with you, I want to personally invite you to join me every single Wednesday at 7 p.m. Central Standard Time for Wind Down Wednesdays. And every other Wednesday, every second and fourth Wednesday is strictly for first-time home buyers. And every first and third Wednesday is for my real estate investors. But I would say listen to all of them because everything is different information. And if you're a first-time home buyer about your first home, and now you're looking to potentially invest, become a landlord or flip, then like I said, you definitely want to listen to it. Even if you're not trying to do it now, it just will encourage you and motivate you to figure out what your next move is. Or may say, you know what, kick rocks. I don't even want to do home ownership no more. I just want to rent. I'm happy. I like the flexibility to do what I want. But anyway, my Wind Down Wednesdays on Wednesday, this is where I will dive deep into real estate and mortgage questions in real time and just explain things. You can ask questions. You can get all the clarity that you need. And this is just really have an honest conversation about buying, refinancing, and just really just investing in today's market. So make sure you subscribe on YouTube to the Real Estate Deal Room. And that's, again, like I said, at YouTube at the Real Estate Deal Room. Turn on the notifications. And I will see you every Wednesday at 7 p.m. Central Standard Time. Thanks again for tuning in. And I can't wait to answer your questions.